what happens if you think that it's going to be, the claims are going to be like this, and then all of a sudden, 6 months into it, there is a severe loss? Do you have to redo the estimates, or do they put in more capital? Do you increase the premiums to cover that? I mean, what are your options? What is the pivot point?
So let's get a little specific. So they bought legal coverage for $50,000 for $1 million policy, and they had a massive event where they just some kind of legal nightmare happened to them during the year, and now they think they're going to be paying out the full policy limit in their legal expense, because it's just worst case scenario. So what happens in their little insurance company is they would have to set up a case reserve. And if there's still too many unknowns for the insurance company, with RMA's claims adjusters help to set up a case reserve, then I would have to set up an IBNR reserve. And this reserve could be $1 million if that's the policy limit, or if it's even much worse than that and they think they'll be on the hook for more, it could be even more. It doesn't happen so often, but it's often it often hits policy limits. So now the company has to have $1 million in case reserve set up, because the reserve opinion said that there needs to be $1 million in reserves. If they have taken in more than $1 million in premiums, then maybe that they can just take the unearned premiums and the unearned premium reserve and just move it right into that case reserve, and then they have a reserve at that time of the year. If they are part of any reinsurance structure, then half of that $1 million can go to reinsurance, and they only have to make sure to put up $500,000. And I know that a lot of your clients have reinsurance so that they can protect themselves from large shock events. And then if they don't have that $500,000 in the company, then they'd have to maybe put up more capital to get up to that reserve amount and still have enough capital to be an insurance company in that regulated domicile. So it really is situational. I think most of the time we try to get captives to diversify their risk by having not just that one policy, but having 10 more policies or 5 more policies, so that if any one shock loss happens in one policy, then they're fine, and they don't have to keep putting up more money every year if they have a few bad years in a row.
True, because it's usually one policy that could have the shock loss on it. And if they wrote 5 or 6 policies, they're not all going to hit.
Right.
There's always the ability to look at that. And one term you mentioned was IBNR in there.
Yes. I'm sorry, I threw that out without defining it.
No, everyone knows what it is, but I just, it's worth defining it.
Yes. IBNR means incurred but not reported. So, for example, we said that the opinion is as of 12/31. So at the end of the year, 12/31, you've, let's say, incurred some legal event happened that you think is going to be covered by your policy. The event has already happened, so you've incurred that risk, but you don't actually know the final payment that's going to be paid out for that claim. So it's an incurred but not reported reserve that we set up at year end. It's just the best estimate of statistically how the loss might play out.
I mean, a perfect example right now is, let's say that these fires in the Palisades and Altadena happened in December instead of January. Then the insurance companies would be setting huge IBNR. They know they have claims, they just don't know when they're actually going to be reported to them.
Right. So they, as a regulated insurance entity, they are required to put up some kind of reserve so that they can pay those claims when they come in. And they might estimate 500 of them, or they might estimate 10,000 of them. And they won't really know that until a few more months of reporting happens.